In my last video, I talked about how bad it is for home buyers out there right now. We talked about the lack of supply and the insane demand that is out there. Another reason is the fact that we are in historically super low interest rate environment. Hey guys, my name is Mac Rogers. I'm a real estate broker here in the East Bay. Today we will go into a little bit more detail on interest rates and how there's not so good news in this front as well. We're currently experiencing historically low mortgage rates. Over the last 50 years, the average on the Freddie Mac 30-year fixed rate mortgage rate has been 7.76%. Today, that rate is an astoundingly low 2.81%. Because of this, everyone has FOMO fever. You know, fear of missing out. Flocks of home buyers have been taking advantage of these remarkably low rates over the last 12 months. Now, here's the bad news. Everything must come to an end. There's no guarantee rates will remain this low much longer. Mark Fleming, chief economist at First American, advises, and I quote, the fallacy of economic forecasting is don't ever try to forecast interest rates and, or more specifically, if you're a real estate economist, mortgage rates, because you will always invariably be wrong, unquote. Now, many things impact mortgage rates. The economy, inflation, the Fed policy, just to name a few. That makes forecasting rates difficult. However, there's one metric that has held up over the last 50 years. That's the relationship between mortgage rates and the 10-year treasury rate. Here's a graph detailing this relationship since Freddie Mac started keeping mortgage rate records in 1972. For almost 50 years, the 30-year mortgage rate has moved in unison with the 10-year treasury rate. There's no denying the close relationship between the two. Over the last 5 decades, there's been an average 1.7 point spread between these two rates. It's this long-term relationship that has some forecasters projecting an increase in mortgage rates as we move throughout the year. This is based on the recent surge in the 10-year treasury rate shown here. The spread between the two is 1.53, indicating mortgage rates could rise. Actually, a bump in the rate has already begun. Joel Kahn, an associate vice president of economic forecasting for the Mortgage Bankers Association, has this to say. Expectations of faster economic growth and inflation continue to push treasury yields and mortgage rates higher. Since hitting a survey low in December, the 30-year fixed rate has slowly risen and last week climbed to its highest level since November of 2020. So the question is not will rates go higher, but more of how high might it go in 2021? Now, no one knows for sure, right? The chief economist for Freddie Mac recently suggested, while there are multiple temporary factors driving up rates, the underlying economic fundamentals point to rates remaining in the low 3% range for the year, unquote. Low 3% is still a very good rate, but this will translate to higher monthly payments that could mean getting priced out in this already hot market. So what does this mean to you? Whether you're a first-time home buyer or you purchased a home before, even an increase of half a point in mortgage rate, say from 2.81 to 3.31, that makes a big difference. On a $600,000 mortgage, that difference, including principal and interest, is almost $200 a month. That's $2,400 a year, or a total of $60,000 over the life of the home loan. So what's the bottom line? Based on the 50-year symbiotic relationship between treasury rates and mortgage rates, it appears mortgage rates could be headed up, headed higher this year. Hey, thanks for watching. Let us know if we can help you with your home buying and home selling needs in the Bay Area. Have a great day.